Hey, Dan Passarelli here. I was talking to somebody just the other day about how to trade when the VIX is high, how to trade when volatility is high. And there's a couple of different things you can do. When the VIX is high or implied volatilities across the board are high, which is what VIX being high indicates, that is generally assumed that there's a lot of volatility in the market. And usually that's true to some degree for sure. There is definitely some sort of correlation between the two, not exactly a perfect correlation, which is going to lead us to one of our points we're going to talk about in a second. So, that in mind, one of the first things you can do is if the VIX is high and volatility across the board is high, and your trading strategy is a little tricky when that market scenario is there, you don't have to trade. You can sit it out and you can wait it out. And when that volatility disappears, come back into the market. Now, that's one thing you can do, and there's nothing wrong with it. Another thing you can do is you can look at it as an opportunity and take some opportunities. Can it be a little tricky? It can, but let me give you a little bit of guidance here. So first of all, when the VIX is high, what generally is happening is because the market is volatile, people are buying up options to hedge, to speculate, etc. And a lot of the time, they overbuy it. They bid it up, so implied volatility ends up being too high. So one of the things you can do is to pick your spots and to sell options, usually in the form of credit spreads or sometimes even covered calls. And when a stock is towards the bottom of a range, that's where we look for selling put credit spreads. And when the stock is towards a top of a range, that's where we look for selling call credit spreads. And if it's a stock you own, perhaps covered calls. Now, when the market's been volatile for a long period of time, there's usually a little bit more fear to the downside. So I always like to be a little bit more careful selling put credit spreads in those scenarios. And I opt to sell call credit spreads when the market is towards the top of a range. You can get into trouble that way too, but there's always more risk when there's more reward. Now, you will come across some other times where on certain stocks at certain times, the implied volatility is maybe not as high as it should be based on how much the stock is moving. And those times can be times when you can look towards straddles. And we've talked about that in some past videos, and I'm sure I'll talk about them again in some future videos. So just know those can be tricky. You have to pick your spots. But when volatility is high but still underpriced, those can be nice straddle trades. I hope that helps. This is Dan Passarelli. Trade smart.